So this is really, I mean, this is a tax question. Of course, we're not tax experts. We're not tax analysts or lawyers. We're equity analysts. We look at stocks, but certainly I can walk through some of the things to consider. So Ryan actually posed this question about a week ago to all of us to just think about because he's had several conversations with clients and they've kind of gone along this route. So regarding the division of assets between an existing TFSA and non-registered or taxable accounts. So some financial advisors of a few of our clients have suggested that their clients sell their growth stocks that have moved significantly higher that they're holding in their TFSAs. So they referred to some of the recommendations that have performed well with Keystone, of which there have been many. Um, the ones that were specifically referred to, I think, Ryan, were Microsoft, Alphabet, and one other that I remember in the email. But essentially, the advice was to sell these companies from the TFSA and then move that capital into a taxable account. So essentially repurchase them in a taxable account so you can continue to hold those equities. And then you would essentially fill up that available space in your TFSA with companies that are paying dividends. And the essentially the rationale here, from what I can tell, is that you want to benefit from the tax shelter on income that is taxed at a higher rate, right? So dividends are taxed at a higher rate than capital gains. So by putting those dividend paying companies into a TFSA, you're essentially sheltering them from taxation. And then if you get capital gains off of your growth stocks, then you're benefiting from the capital gains tax treatment, which for those that aren't aware, it's or was anyways, a very simple 50% of your capital gains would be taxed as regular income. So if you had a 40% marginal tax rate, 50% of that, 20%, that would basically be your tax rate on capital gains. Now, there were some recent changes to the capital gains rate, but we're not gonna really get into that too much. Really what I want to talk about here is this good advice? Should clients follow this advice, right? So because I'm not actually talking to these advisors and being able to pose some follow-up questions to them, I'm going to have to really speculate in terms of what some of the motivations are. I'm making an assumption here that when they highlight companies like Microsoft and Google that have done well, they're essentially assuming that these companies are now closer to fair value, and you're not going to see anywhere near that level of capital gain in the future. So you basically lock in those huge gains, tax free, move those companies if you still want to own them into a taxable account, and then put dividend paying stocks into your tax free TFSA. So what I want to do is I just want to pose a couple of different scenarios here, because really when it comes to taxation, everybody's situation is going to be completely different. What your marginal tax rate is, other factors are going to enter into this, and I'm going to just basically show how this works. But before I do that, I want to make sure that I'm very clear here in the disclaimer. This is not intended to be tax advice. This is just for informational purposes. I'm going to make some assumptions here, and I'm also going to make some estimates as well. So don't take this as specific tax advice. So what I did is, rather than speculate qualitatively on whether or not this was good advice or not, I really just put this into a spreadsheet so I could calculate a few different scenarios and see how much tax you're essentially paying, depending on whether or not you're having those growth stocks in your portfolio, or if you take this advice and move out the growth stocks and add in the dividend stocks. So scenario one is basically the growth stocks remain in the TFSA, and the dividend stocks are in the non-registered accounts. So this is the status quo that these investors are already essentially have. And then scenario two is taking the advice of the financial advisors, which would be to move the growth stocks out of the TFSA into a non-registered account, and the dividend stocks into the TFSA. So a few assumptions that I'm making here. are over here on the left side of the spreadsheet. So we're just going to basically, we can change these, and we will, to see how it changes the tax implication. But for the growth stocks, we're just going to assume average price appreciation over a period of time of 12% per year. And this period of time right now we're assuming is going to be 5 years. And we're going to assume that the investor has a marginal tax rate of 40%. So every additional dollar they earn is taxed at 40%. So 12% average price appreciation from the growth stock. And then for the dividend stock, we're going to assume an initial yield of 5%. And then a dividend growth rate of 5%. So every year they're increasing that dividend 5%. And the stock price is going to appreciate roughly in line with the dividend growth. So about 5% per year. And again, 5 years over a 5-year period, and a 40% marginal tax rate, just the same. Okay, so in scenario one here, we can see, because the growth stocks are in your TFSA, you will pay zero tax. And the dividend stocks, because they're in the non-registered account, you will pay tax on the capital gain after 5 years. And you will also pay tax on the dividends in the years that they are received. So your total tax over the 5-year period in this scenario one is going to be about $12.43 I have here. Again, approximately. These numbers are going to change depending on your tax rate. Whereas in scenario two, this is where you take the financial advisor's advice, you move those stocks around, then you're going to incur about a $15 tax implication on your growth stocks, no tax on your dividend stocks because they're in the TFSA, and you're basically going to be paying just over $15 in tax, right? So you can see, based on these assumptions, you obviously want to pay the lower tax rate, which in this case would be scenario one, and that's just maintaining the status quo. You keeping your growth stocks in the TFSA, dividend stocks in the non-registered, right? Now, the financial advisors specifically mentioned Microsoft, and over the time period that we've recommended Microsoft, say over 5 years, the average price appreciation has actually been about 33%. So I'm just going to change this and see how that changes the equation, right? So we put in 33%, and we can see that you are actually then saving a significant amount of money, because if you had to pay tax on that, then you would be paying about $63 in tax. So several times the tax burden by taking the advice. Now, this is assuming, of course, that the future price appreciation of Microsoft is going to be 33% per year. I don't believe that it will be. And I think that's also probably the point that the financial advisors are making. But I do still consider it a growth stock. So, even at 12% to 15%, even at 12%, you're still better off to keep them in your TFSA. And I mean, 15% is probably not unrealistic for the company either over 5 years. So you're even better off to keep that tax sheltered. But what if it goes down to 10%, if it averages 10%? Well, now you're, about even, right? So essentially anywhere under 10%, assuming all of these other factors remain the same, is where you're going to have more of a benefit keeping your dividend stocks in the TFSA, because you're paying the higher tax rate on them. So that really is what it comes down to. So the financial advisors are correct when they say that the tax rate on dividends, eligible dividends, is higher than the tax rate on capital gains. And therefore, you get a benefit by sheltering that higher tax rate. But that's the rate. That doesn't actually refer to the dollar amount that you're saving or spending on taxes. And it's really the dollar amount that's most relevant here. So you could take you could take a scenario where Hammond Power. I mean, what was the price appreciation of Hammond Power, Ryan, over
5 years, about 1,500, 1,900%, depending on where it's
1900%,
trading. Yeah,
right?
yeah.
So, if you have a situation like that, sure, you are paying a lower tax rate on the capital gain, but the dollars of capital gains are so astronomically higher than what you're getting from dividend income, that even though it's a lower rate, you're still going to be paying far more tax. right? So that's really what it comes down to. Is it's not a matter of necessarily what security do you have that is paying the higher or the lower rate, but it's also, what level of return do you expect? So in the case of some of these growth stocks or stocks that have done well, it's really going to depend a lot on what your expectations are going forward. It's as I said with Microsoft, it's 33% since our recommendation annually per year 5 years ago. That's not our expectation going forward. Our expectation going forward would be 10 to 15%. So at 12%, you're still better off, assuming everything else, um, all the other assumptions are correct. You're still better off essentially sheltering those capital gains in a TFSA. Um, at anything over 10%. At anything under 10% return annually compounded, then you would start to be better off to shelter your dividends. So that's really what it comes down to, is the dollars that you're saving. And of course, this assumes that you have knowledge of what these returns are going to be in the future, which of course you do not. With dividends, there's a little more certainty because you know what your dividend is. A dividend growth rate can be more predictable than stock price appreciation. But at the same time, it's something to consider in terms of, it's not just about the tax rate. It's about the quantity of dollars that you're shielding from taxes as well. So having companies like Hammond Power or Microsoft or Google or Brookfield Infrastructure, XPEL, or many of the companies that have performed extraordinarily well with respect to capital gains over the years, having those shielded in a TFSA is absolutely has a phenomenal impact on your tax savings as an investor. So now that said, if you have performed extremely well on a company that is in your TFSA, a growth stock, and you think that one, it may be overvalued now, or your expectation for future returns are significantly lower, perhaps lower than maybe even the market average, then certainly at that point, yes, it would be advantageous, if you're correct, to lock in those gains tax free, and potentially purchase it in another account or not. But what you replace it with in your TFSA shouldn't just necessarily by default be a higher tax security. I mean, for example, you could even higher tax security would be a fixed income investment, which
Yeah.
might be paying 3% per year with no growth. Well, sure, you're saving a much higher tax rate, but not many tax dollars there. So this is something to consider. Another thing is if you've generated so much appreciation from a growth stock that you want to rebalance it or need to rebalance it because it's becoming too high a percentage of your portfolio, then in that case as well, you can lock in those profits in your TFSA. That's great. But when replacing that contribution room in your TFSA, it may be better to put the next growth stock in as opposed to the next dividend stock. So that concludes this. And I will let you guys ask if you have any questions.
Yeah. I mean, it really comes down to your expected return on the security that you have there or you're buying going forward. If it's going to be like the math there, it's going to be above 10% over the long term. You're probably better off having that company, a growth company in the TFSA. Now, this is a very specific, like we've had this because we've had tremendous gains and some people hold those within a TFSA. It's a very specific scenario, huge gains from good growth stocks in an existing TFSA, selling with no tax implications, bank the room in the TFSA, move dividends, which are higher taxed, buy some of the same growth stocks in a non-registered taxable account. I mean, again, the issue would be, and Aaron just said this, you're moving the highest growth assets from a fully tax sheltered account and moving in lesser growth assets. Near term, it could look good, but if you've got 10 years plus, the capital gains in the future, if you're looking if you're looking to gain 10 to 15 plus percent on an annual basis from those growth stocks, which, you should be somewhere in that range, hopefully you can do better. You've moved those by far the largest gains there versus the dividend companies, which would be likely lower. So you're then liable outside the tax sheltered account for the capital gains, which, you know, the rate you're going to, what you're going to have to pay in that is higher. So, I mean, growth stocks are higher risk. I mean, I've heard clients say, well, there's no benefit if I have a loss in a TFSA. You can have a loss carry forward, and you can hide gains with that as well. But again, I think you're getting a little too cute there. You're really just looking to find the best companies, and the best growth companies, in theory, should be held in the most tax advantage account. If you're successful with your growth on those companies, it's typically going to be better. It is going to be better to hold them in a TFSA if you can. You're in this scenario, if the call is that the valuations on all the companies that are growth oriented in your TFSA are too high, and that's why you're selling them, that's more a call on the valuations. If you think those are overpriced securities, uh, you're not doing this scenario to be cute and brood it up. Pull those out and put the higher taxed uh, income stocks in that TFSA structure, because really your question should be, do I want to sell these because they're overvalued? If it is, then your best scenario still might not be to replace that with dividend stocks. It might be to find other growth stocks that you think are undervalued that can grow, because again, that would be a better scenario. But if you think those are just good companies and you think they're going to grow beyond 10% over the next 10 years, then you're better to likely have those in your TFSA, just under the simple math of it there, than have them outside. And like Aaron just said that. So, but I mean, it's sometimes it can look good in the short term, and all of that financial maneuvering sounds smart, but is it, if your highest growth assets are getting moved to a higher tax situation? That doesn't sound, it isn't good.
Like, I think the thing is, and I'm just gonna be parroting it again, but I think like the advisors are really just coming from taxation avoidance, or like just general taxation theory, essentially. Like, and I ended up doing a segment in one of our webinars on this, where again, like, I'm parroting what these guys are saying. General taxation theory says place the most tax efficient assets in taxable accounts and tax inefficient assets in tax deferred and tax exempt accounts, so the RRSP or TFSA. But again, what the guys are trying to get across is there's this trade off between these growthier assets, outsized returns in tax benefited accounts, compared to lower growth tax and inefficient assets. So again, there's this trade off. um you know Anyways, I'm just
And even if
literally
you're going to get
repeating what you're saying.
even if you just put an indexed ETF in there, the general long-term market return, 10 to 11%, even if it's at 11% over time, you're probably better off having that growthier
Yep.
oriented asset in the tax deferred or tax sheltered account. And if you're trying to beat the market over the long term, if that's your goal, and you can achieve that, you certainly are better by the math having it in the highest growth assets there. Yeah, you're talking about avoiding the most tax, in theory. If you think
Yeah.
if the dividend stocks were going to have the same return as the growth stocks, then maybe it makes sense.
Yeah.
But why call it a growth stock? If you're looking for a growth stock, it's supposed to grow faster than the dividend stock. We have growth stocks that are dividend growth stocks too. So that convolutes the entire argument, really, because you have companies that are both paying a good dividend, growing that dividend, and expected to grow their share price or unit price above what you would see on average for a dividend stock, potentially like just a stodgy old dividend stock. Not, but these are dividend growth stocks. So yeah,
And like,
try
that's
to
one
find the
thing
best
too.
assets that are going to grow the best and put them in that account that's tax deferred or
And
tax
these
sheltered.
profitable businesses, nice cash rich balance sheet. I mean, you guys hear us talk about this. The last thing that I want to see is for, a client or an investor to have a bunch of junior exploration companies in their TFSA or something, which is,
Now that we can
putting.
tell you is a terrible
Exactly.
strategy.
That is a terrible idea. But, I just want to make sure that someone's like, oh, they're saying put, these
Well,
higher
those aren't
risk
growth.
assets. No, like, that is one thing where, don't, because the risk of you losing your money in a junior exploration company or business, if you can call it a business, is very high. And you would want to be able to take that tax loss in the future. Again, we're not saying to stay
Just
away,
don't buy
steer
them.
clear from junior exploration.
I'm buying them to
But
get the tax loss.
it's
That's
just
what I'm doing.
again, this is something that we hear from either
Yeah.
prospective clients or just people out there asking questions.
The one major factor I would mention as well is this can actually shift with your tax brackets as well quite a bit. So the
Yeah.
difference between if you actually earn on the lower tax brackets, I'm looking for Alberta, under 114,000, your dividends are actually taxed at a lower rate because of the dividend tax credit on a marginal basis.
Yeah.
So you do end up in these quirks, and it changes even more now that we have the excess returns over 250,000 for capital gains, and it varies by province. It's a lot more complicated when you're looking at which is the most tax efficient.
Yeah, no, it's the calculation of the dividend tax credit is gonna. I mean, there's not one number you can multiply your marginal tax rate by. It really depends what your marginal tax rate is.
Exactly.
And you have to go through a calculation, which isn't extremely complicated, but it's still outside of what we were talking about. But no, that's the point, is that as your marginal tax rate goes down, it's the I think at 30% or 30% marginal tax rate, or maybe a little lower, you're basically getting down to about the same.
It will depend on the province.
Yeah.
And that's it. And it's very difficult because especially when you're looking at those 10-year holding periods, if you do have a massive capital gains, it could push you in a higher bracket too, which then changes your what would have been optimal.
Yeah. Let's get rid of the new capital gains that just came in. Can we do that?
I can't do anything.
Start a campaign, Brennan.
Yeah.
You with the hat.
I'm gonna get some signatures. Yeah.